Are you making these common crypto trading mistakes? The crypto market is full of potential, but it's also a minefield. Avoidable errors can lead to fast losses and frustration. Today, we'll cover top crypto trading mistakes and how to avoid them. Think of this as your guide to sidestepping financial pitfalls. Let's dive in and empower your trading journey. The biggest mistake? No research. People hear about a coin, see a price pump, and throw money in. It's like buying a house without looking inside. You wouldn't do that with a physical asset, so why with crypto? FOMO drives impulsive decisions. Research is the bedrock of responsible trading. Next up, let's talk about emotional trading. Crypto markets are notoriously volatile, right? We see these massive swings, huge green candles followed by terrifying red ones. And what happens when you're watching your money fluctuate like that? Your emotions go into overdrive. Fear kicks in when prices drop, leading to panic selling at the bottom. Greed takes over when prices are soaring, causing you to FOMO in at the top, right before a correction. It's a vicious cycle, and it's one of the quickest ways to decimate your trading account. Think about it. When you're making decisions based on fear or greed, you're not thinking rationally. You're reacting. You see your portfolio drop 20% in an hour, and that little voice in your head screams, "Sell! Sell now before it goes to zero," so you sell, locking in your loss. Then a few days later, the market recovers, and you're left watching from the sidelines, kicking yourself. The markets are designed to play on these emotions. Whales, or large holders, often manipulate prices to trigger these fear and greed responses in retail traders. If you're trading emotionally, you're essentially playing right into their hands. Alright, this brings us directly to the third critical mistake. Trading without a clear strategy. This is like setting sail across the ocean without a map, a compass, or even a destination in mind. You're just drifting, hoping to stumble upon treasure, but more likely, you'll end up lost, battered by storms, or sunk. So many people jump into crypto trading thinking they can just buy low and sell high, but they have no actual plan for how they're going to achieve that consistently. They're essentially winging it, and that's a surefire way to underperform, or worse, lose your capital. What does a trading strategy actually involve? Well, it's a comprehensive set of rules that govern all your trading decisions. It should define what kind of assets you'll trade, what market conditions you'll trade in, your criteria for entering a trade, perhaps based on technical indicators like moving averages or RSI, or fundamental triggers like project news. It also dictates your position sizing, how much capital you'll risk on any single trade. And, as we just discussed, it absolutely must include your exit strategy, your profit targets, and your stop-loss levels. Without these predefined rules, every trade becomes a guess. A strategy provides discipline and objectivity, two of the most valuable assets a trader can have. Now let's talk about something that can accelerate your losses faster than almost anything else in crypto trading: over-leveraging. Leverage, in simple terms, is borrowing capital to increase the size of your trading position beyond what your own money would allow. For example, with 10 times leverage, a $100 deposit can control a $1,000 position. Sounds great when the market moves in your favor, right? A 10% gain on that $1,000 position becomes a $100 profit, effectively doubling your initial $100. But here's the terrifying flip side. The problem is, leverage magnifies losses just as much as it magnifies gains. If that same $1,000 position moves against you by just 10%, that's a $100 loss. And since your actual capital was only $100, you've been wiped out, liquidated. Your entire deposit is gone. Many exchanges offer insane amounts of leverage, 20 times, 50 times, even 100 times or more. Ignoring market trends is a common mistake. The trend is your best friend in crypto. Fighting a strong trend leads to frustration and losses. It's like swimming upstream in a powerful river. Understand market sentiment and primary trends. Finally, let's talk about a mistake that can make all your trading profits and research utterly meaningless: poor security practices. You could be the best trader in the world, picking all the right coins, timing your entries and exits perfectly, but if your crypto isn't secure, you could lose it all in an instant to hackers, scammers, or even your own carelessness. It's heartbreaking to see people build up a significant portfolio only to have it vanish because they clicked on a malicious link or didn't enable basic security features. This isn't just about trading, it's about safeguarding your assets. The crypto space, unfortunately, is rife with bad actors looking for easy targets. Phishing scams are incredibly common. Fake emails or messages pretending to be from exchanges or wallet providers, trying to trick you into revealing your login credentials or private keys. Then there are malicious smart contracts, fake airdrops and malware designed to steal your crypto. If you're not vigilant, you're making yourself a prime target. You absolutely have to treat your crypto security with the same seriousness, if not more, than you treat your online banking security. So, what are some essential security practices? First and foremost, use strong, unique passwords for every single exchange and crypto-related service. Don't reuse passwords. Use a password manager to keep track of them. So, those are the top crypto trading mistakes to watch out for. Do your own research, avoid fear and greed, and have a clear strategy. Respect market trends and practice robust security. If you found this helpful, smash that like button. Subscribe and ring the bell for more tips. Leave a comment with your crypto trading mistakes or tips. Thanks for watching, trade smart, and see you next time.